We have a really rough start to the day after April Fool's Day. Feels more like April Fool's Day should have been today. The markets are down and Tesla is down more. So Sawyer Merritt has it this way. Tesla delivered 386,783 vehicles in quarter one. We all know what the expectations were. Troy Teslike comes in the winner, but he was at 407,000. Wall Street expecting 431, but total quarter one production was 433,371. Now, this is the big question. We have 33 and 14. We got almost 50,000 more vehicles made than shipped. There's got to be more to the story, way more to the story. I might do an extra show later today because we got, Brian White at around 11:12. It's already in the can. So I might need to do an extra show, but otherwise we'll just talk about it this evening when we have, yes, we have Nicholas Gibbs on tonight. So, but I might do a separate show because this makes no sense. So Sawyer Merritt goes on to say, decline in volumes was partially due to the early phase of the production ramp of the updated Model 3 at our Fremont factory and factory shutdowns resulting from shipping diversions in the Red Sea, the arson attack on Gigafactory Berlin, all those things we knew about. These are all in the report this morning from Tesla. But these only explain why the production numbers would be low, but I don't think 433,000 is particularly a rough number in terms of production. Tesla also reported record Megapack installations for the first time on this delivery report, 4,053 megawatt hours. I have not had time to go check out what that really means in terms of comparisons with previous quarters, but I will do that. And again, I might do a separate show later today. Or I will just do it tonight when we talk to Nicholas. Two questions. Why is the shipping number so much lower than the production number? That would suggest a demand problem. Some people are saying that there could be a lot of product on ships at sea. That would be a lot of product on ships at sea, but maybe that is a problem. The other question would be, we know what the China numbers are. We have pretty good information on the Europe numbers. This looks like a miss in the United States. Why would we have such a big miss in the United States with all the things that I've been talking about, in terms of the Cybertruck halo effect, the new, what we would call a halo effect from the full self-driving improvements, et cetera, et cetera, et cetera. Why would the numbers be off so much in the U.S.? Tesla's China insurance registrations came in for the last week. They came in with a monster number at 17,300. So then the second question I have is, if we know the China numbers, we know the Europe number, anyway, but how did the analysts miss it by so much? How did everybody have it even higher than Troy Teslike at 407,000? What in the world went wrong with the ability to figure out these numbers using registrations and VIN numbers, et cetera? Anyway, Reuters says U.S. automaker Tesla sold 89,064 China-made electric vehicles in March, which is a 0.2% increase from a year earlier. So so we get those numbers. Those look fine. Deliveries of China-made Model 3 and Model Y vehicles were up 47% from February because, of course, February had Chinese New Year. Then there's this from the Washington Post. I've been saying this over and over and over again, but it doesn't seem to get past people's thoughts. So people just think this can't be right. I don't know why. So here we go. Tesla Boomer Bomber says, by default, I mean, she's just reporting on this Washington Post report. By default, listen now, driverless passenger vehicles and trucks can ride anywhere in the United States unless a state explicitly says they can't. That means companies can test and operate their vehicles across most of the country. 24 states, including Texas, Florida, Arizona, and Nevada specifically allow driverless operations, according to data compiled by Aurora, while 16 more states have absolutely no regulations specific to autonomous vehicles. The remaining 10, including California, Massachusetts, and New York, place limits on them. So I've been saying this all along. If FSD is fully ready to go, and Elon Musk makes the statement, okay, you can take your hands off the wheel, you can get in the back and cuddle up and take a nap. It can be done in most places in the United States, and there are no federal rules to stop that from happening. So there you go. Back on the other news for a minute, though, in terms of the total numbers, please understand this is a serious break in the narrative, and it's going to take some real significant news to fix this. We'll talk again. Lots more conversation to be had later today. I am a little nervous to even report this as it was posted late on April 1, but it looks good. It looks correct. It was shown in the German and in English. Anyway, this is from Nicholas, Nicklas, Nilso, Nilsso 14 on X this morning. Tesla, together with IF Metall, agree on a collective agreement. The strike in Sweden, now over 5 months long, will be called off, according to IF Metall's contract secretary. Can't pronounce that name. So this is just like a notification. I'm a little shocked to hear this. Wondering why Tesla might have reconsidered and is now entering into collective bargaining. Anyway, we'll find out what's going on there as the day progresses also, I suppose. Anyway, this is Randy Kirk. If you haven't hit the like button yet, that would be a very, very nice thing to do on such a tough morning. Give me a bunch of likes so that I can feel like everything is great. Anyway, even when it's not looking so great today. We got, as I mentioned, Nicholas Gibbs. Later today, we've got Brian White on, and Brian White and I are going to have a lot of fun. I think you'll really enjoy today's show. And then, of course, love to have you go down below, check out Patreon and join Patreon. And there seems like I'm leaving out one more thing, but I don't know what it is. Okay, so markets are down big again today. It's interesting that this early drop, running around $11 on Tesla this morning, not as big as it might have been, given that the market is down so much. Now, why is the market down again so much this morning? Well, part of it would be the oil problem. The oil problem is getting bigger and bigger. The oil problem impacts what? It impacts everything. And then if you got the oil the oil price is going up, impacting every other price, then you have an inflation issue, right? Okay. So then the inflation issue, what does that impact? That impacts interest rates. And so this morning you also have, for the very first time, less than 50% of those being that are involved in the polling, less than 50% are saying now that we will have an interest rate drop in June. That's what I've been saying for the last couple of days. I think there's no chance that there's going to be an interest rate drop in June unless these numbers on Friday, the job numbers come in a lot lower than expected. So here's what CNBC is saying about the oil this morning. OPEC member Iran has blamed Israel for a deadly Monday airstrike on its consulate in the Syrian capital of Damascus that reportedly killed 7 of its officers. Tehran on Tuesday pledged to take revenge for the attack, which was seen as a major escalation in the Israel-Hamas war. Israel has not declared responsibility, and a government spokesperson said they would not comment on foreign media reports on this subject. PVM's Varga warned that potential for direct Iranian involvement in the Israel-Hamas war could spark a region-wide conflict with a plausible impact on oil supply. The Ukraine on Tuesday also struck one of Russia's largest oil refineries with a drone attack on the highly industrialized Tatarstan. Pronounce that, Tatarstan region southeast of Moscow. And anyway, that's around 1,300, about 800 miles from the front lines of the conflict. The head Russian there said that the industrial locations have been targeted by drones in these towns recently. There's no serious damage, but they continue to do these attacks on the oil refineries, and that is having an impact on oil prices, of course. Okay, hopefully you're going to be interested in this. I took the time. This is a very long article, but this may be as critical as anything that you're going to hear in terms of where the economy is going, in terms of where we're going to have some serious problems downstream. Now, this could be 2 years out, could be a year out, or it could be next month, depending on how things continue to develop. I'm going to say before I go into the article from Bloomberg, I want to say also, we've got these 2 big days down on the Dow. We've talked about the fact for the last 3 or 4 days, I've talked about the fact for the last 3 or 4 days that we might be seeing too much exuberance in the stock market, that there hasn't been a pullback for a very, very long time. We've had one of the biggest run-ups in history over the last 5 months on these on the equity markets. It may be time for an actual, 10% pullback. And if people are looking for an excuse to pull back, obviously the oil thing could be that excuse. There could be the excuses this Friday could add to it if we continue to see what I consider to be not great results on the labor front. Anyway, let's dive into this Bloomberg article, which could give yet another reason. Janet Yellen told lawmakers in February, "I do believe we need to reduce deficits and stay on a fiscally sustainable path. The Biden administration proposals offer substantial deficit reduction that would continue to hold the level of interest expense at comfortable levels, but we would need to work together to try to achieve these savings." Well, nothing in the budget that just came out would suggest that the Biden administration and or the Republicans are doing anything to move towards fiscal responsibility. The trouble is, according to Bloomberg, delivering a such plan will require action from a Congress that is bitterly divided on partisan lines. Republicans, who control the House, want deep spending cuts. Yes, this is true, to bring down the ballooning deficit without specifically and specifying exactly what they'd slash. I added a couple of words there. Yeah, this is the problem, that the Republicans need to spell it out, but they're not going to spell it out because the Democrats are going to use it in an election year. Democrats who oversee the Senate argue that spending is less of a contributor to any deterioration in debt sustainability, with interest rates and tax revenues the key factors. In other words, as always, the Democrats want to raise taxes. And who do they want to raise them on? They want to raise them on the folks that are generating all of the new jobs in the world, the people that are rich. And also, you can't ever get enough money from that group. At a certain point, they just turn tail and run, and they find ways not to pay them anyway. So you've got all these issues. These are cross currents, of course, completely no agreement. In the end, it may take a crisis, according to Bloomberg, perhaps a disorderly rout in the Treasury's market, triggered by sovereign U.S. credit rating downgrades again, or a panic over the depletion of the Medicare or Social Security trust funds. A panic over, I don't know why people worry about the panic in the Medicare or Social Security trust funds. There's nothing is going to change with regard to those trust funds to force action. That's playing with fire. Yes, the Social Security trust funds need to be dealt with. The Medicare trust funds need to be dealt with, but they need to be dealt with by changing the methodologies for collecting the taxes, or the way that you do tax, the tax on those, and also by the amount that's being handed out. They do need to be dealt with, but they're not going away. They just need to be moderately trimmed. Anyway, for the U.S., the dollar's central role in international finance and status as the dominant reserve currency lowers the odds of a massive meltdown. It would take a lot to shake investor confidence in the U.S. Treasury debt as the ultimate safe asset. If it did evaporate, though, the erosion of the dollar's standing would be a watershed moment, with the U.S. losing not just access to cheap financing, but also global power and prestige. Yeah, but who's going to replace the U.S. dollar? China is in bigger trouble. Japan is barely getting itself out of a 30-year recession. You're not going to go to Europe and find any country over there that's going to replace the dollar. No, it's not going to be the euro that's going to replace the dollar. No, there's no place to go. The U.S. dollar right now, the U.S. economy is the strongest in the world by a lot. So that isn't going to be the issue, but it's still a big issue. And as as people have said for at least 100 years, I'm pretty sure it's right around 100 years, if the U.S. sneezes, the world catches a cold. How does the CBO, Washington's official budget watchdog, arrive at its debt forecast? Well, the CBO, it looks at certain crucial variables. They're assuming GDP growth around 2%. They're assuming inflation returning, I'm adding the word assuming. They're assuming inflation returning to 2%. They're assuming interest rates drifting down from current levels. And all of those are squarely in the ballpark of plausibility, according to Bloomberg. They're also not far from the numbers the Federal Reserve Bank is forecasting. However, the CBO's view on rates is a little higher than the most recent consensus. If we look at them closely, says Bloomberg, the key assumptions underpinning the CBO forecast appear optimistic. By law, the CBO is compelled to rely on existing legislation. That means it assumes, I didn't put that one in there, it assumes that the 2017 Trump tax cuts will expire as scheduled in 2025. But even President Joe Biden wants some of them extended. According to Penn Wharton budget model, permanently extending that legislation's revenue provisions would cost about 1.2% of GDP each year starting in the late 2020s. Of course, this is a nonsense. The Trump tax cuts are, to the extent that you remove them, you are more likely to have a decrease in the overall GDP, not a decrease in how can I say this? The GDP would go down, which would result in fewer taxes being collected. But of course, that's not how the deep state in Washington would count those tax cuts. The CBO also must assume that discretionary spending, which is set up by Congress each year, will increase with inflation, not keep pace with GDP. As a result, defense spending falls from around 3% GDP to 2.5% in the mid-2030s. That's a tall order given the wars currently raging and the geopolitical threats that loom. Former Treasury Secretary Lawrence Summers says a more realistic forecast would be to add at least 1% of GDP to the CBO's outlook. So everything about these numbers, except in my opinion, the Trump tax cuts, are all way optimistic. Market participants aren't buying this benign rate outlook, with forward markets pointing to borrowing costs markedly higher than the CBO assumes. Bloomberg Economics has built a forecast model using market pricing for future interest rates and data on the maturity profile of bonds, keeping all of the CBOs, now listen to this, keeping all of the CPO's other assumptions in place. That shows debt equaling 123% of GDP for 2034. Debt equaling 123% of GDP in 2034. Debt at that level would mean servicing costs reaching close to 5.4% of GDP, more than 1.5 times as much as what the government spends on national defense in 2023 as a percentage. Not as a dollar amount, as a percentage, and comparable to the entire Social Security budget. So this would have interest passing Social Security or getting close to Social Security. Heavyweights from across the political spectrum agree to the long-term outlook being unsettling. Fed Chair Jerome Powell said earlier this year it was probably time or past time for politicians to get going on addressing the unsustainable path for borrowing. Former Treasury Secretary Robert Rayman said in January, the nation is in a terrible place with regard to deficits. From the realm of finance, Citadel founder Ken Griffin told investors in a letter to the hedge funds investors Monday that U.S. national debt is a growing concern that cannot be overlooked. And then days earlier, BlackRock's chief executive officer, Larry Fink, said the U.S. public debt situation is more urgent than I can ever remember. Ex-IMF chief economist Kenneth Rogoff said that while an exact upper limit for debt is unknowable, there will be challenges as the level keeps going up. Rogoff's broader point is well taken. Forecasts are uncertain. To put some parameters around that uncertainty, Bloomberg Economics has run a million simulations on the CBO's baseline view. This is an approach economists call the stochastic debt sustainability analysis. Each simulation forecasts the debt to GDP ratio with a different combination of GDP growth, inflation, budget deficits, and interest rates, with variations based on the patterns seen in the historical data. In the worst 5% of outcomes, the debt to GDP ratio ends 2034 above 139%, which means that the U.S. would have a higher debt ratio in 2034 than in crisis-prone Italy last year. Yellen has another way of thinking about debt sustainability. Inflation-adjusted interest expense which she indicated she preferred to see below 2% of GDP. She says, on that basis, the results are more hopeful, finding that the metric averaged over the next 10 years violates the threshold in less than a third, 30% of the simulations. The Treasury chief herself acknowledged in a February 8 hearing that in an extreme case, there could be the possibility of borrowing reaching levels that buyers wouldn't be willing to purchase everything the government sought to sell. She added that she saw no signs of that right now, although we've had some difficult Treasury sales recently. Anyway, getting to the unsustainable path. I'm sorry. Let me restate that. It was a little Freudian slip here. Getting to a sustainable path will require action from Congress, but the precedent isn't promising. Disagreements over government spending came to a head last summer when a standoff over the debt ceiling brought the U.S. to brink of default. The deal to halt the havoc suspended the debt ceiling completely until January of 2025, where the new president will have to figure it out. It's hard to imagine a U.S. debt crisis. The dollar remains the global reserve currency. Just said that. There's no way it's going to be anything other than the dollar. The annual and unseemly spectacle of government shutdown brinkmanship typically leaves barely a ripple on the Treasury market. Still, the world is changing. China and other emerging markets are eroding the dollar's role in trade, invoicing, cross-border financing, and foreign exchange reserve. Foreign buyers make up a steadily shrinking share of the U.S. Treasury's market, testing domestic buyers' appetite for ever-increasing volumes of federal debt. And while demand for those securities has lately been supported by expectations for the Fed to lower interest rates, that dynamic won't always be in play. No, but you have the interest rates going up this morning. You've got the gold going up like crazy right now. All of this is more indicative that there's a problem. Herbert Stein, head of the Council of Economic Advisors in the 70s, observed that if something cannot go on forever, it will stop. If the U.S. doesn't get its fiscal house in order, a future U.S. president will have the truth of that maxim confirmed. And if confidence in the world's safe asset evaporates, everyone will suffer the consequence. So, what do you think about that? Let me know in the comments below about everything that we've talked about today. What about these missed numbers from Tesla? Where are the missing numbers? Why is there so many more produced than sold? Where is that inventory? Is that inventory sitting in lots across the country someplace? Is that inventory sitting on ships? What in the world is going on? And now let's take a look at where the markets are now. What are people saying about Tesla? Interesting. It's so amazing to me. Tesla is only down 9 right now. We have got the Dow down 435. We've got the NASDAQ down 216, S&P down 47. We have got all the Magnificent Seven. Well, that's not quite true. Meta is actually up a tiny bit this morning, but the rest of the Magnificent Seven is down hard. NVIDIA down 18, down to 884 this morning. So everything except for Meta is getting blasted this morning. We go to the Cathie Woods, of course, they are also, because of the treasuries being up so strongly this morning, the Cathie Woods are getting slammed, which is what I expected yesterday. But let's look at percentages here. We have got the Dow Jones down 1%. We've got the NASDAQ down 1.32%. We've got the S&P down 0.88% and Tesla down 5.16%. So about half of the decrease in Tesla this morning would have happened anyway based on the normal delta compared to the NASDAQ. We would be expecting it to be down somewhere in the range of 3% anyway, and it was only down 5.2%. So quite frankly, people are taking this big miss much more in stride than I would have expected. I would have expected much lower numbers. So maybe my comments about the narrative switching to the importance of things like FSD and robotaxis and Optimus, maybe some of that is actually already in there. I don't know. A lot more thought needs to go into this morning and a lot more research. I really think there's a possibility I'll need to do a fourth show today. As much as I don't really want to do a fourth show today, I might be doing that because you all should demand it. Let me know in the comments below. Do I need to do a fourth show today in order to dig into all of this a little deeper than I've been able to this morning? All right, let's go over to the bonds. Let's find out just how bad that is this morning. I know roughly where we're going to be on the bonds. Let's see where we actually are. Oh, I just hit the wrong thing. I'm so sorry. Here we go. We have got the bonds. Oh, up another 5 basis points, 4.381, 5 basis points. Interestingly, okay, now here you go. This is interesting. This is super interesting. I know it's only one data point. I know it's only one day, but what you've got right now is you've got the 10-year up 5.5 basis points with the 2-year down 0.6. Some people have said that when the inversion starts to close, it won't be because the 2-year goes gets stronger and catches up to, I'm sorry, yeah, it won't be because the interest rates are lower on the 2-year. It'll be because the 10-year interest rates go up and catch the 2-year. So that's what we've got taking place this morning, a major decrease in the inversion, but it's being caused by a sell-off on the 10-year and people actually buying the 2-year. So that is, yeah, again, one data point, not even a full day, but very interesting in my opinion. Okay, we've got oil up almost $1, 86 cents at 84.58. That is obviously a recent high. We've got the Brent up 88.28. Now this is interesting. It's not even $4 different. Everybody's saying, the CNBC article that I read you said it's all about what's happening in the Red Sea, what's happening in Israel, what's happening in Iran, what's happening in Russia, but that would generally mean that the Brent would go up more. Now, you could say, okay, what this is Texas Intermediate catching up to Brent, just almost kind of like what we just talked about with the 10-year and the 2-year. That could be possible, but right now, at least, that difference is less than usual, even as both of them are very high, and Brent is getting ready to break in the 90s at the rate we're going. We got natural gas down again. A couple of articles about that this morning. I think that's just seasonal mostly, but natural gas is still $1.81, which is not near the low that we've seen recently. We've got the dollar hitting 5-month highs. Of course, with the interest rates going up this much, people are going to be buying the dollar. And as I pointed out, there is no other reserve currency, so that's not an issue. We've got gold going up again, $27, 2,284, another all-time high. Copper up 0.86 this morning at $4.08. It's been consistently up the last 3 or 4 sessions in a row. We have got the Bitcoin down 4,000 at 65,395. That is not apparently going to be the safety play, as everybody's been talking about. I don't know anything about this Bitcoin. I really don't. But one thing I do know is people are saying, well, people are going to the Bitcoin for safety. But if people are looking for a safe haven right now, that is not what where they're going. Down 4,000. Okay, we have got, that is all of that. I really need to get off of here. Let's go take another look at Tesla. Down still $9, still the same thing. Interesting. Remember, Brian White and I, yesterday, we did an amazing video that you do need to take a look at. That was all about, what was it about? I don't know. My mind is just fried right now. Go back and take a look at it. I'll just put the card up. Whatever we talked about, it was fun. It was interesting. And a lot of people liked it. I do remember that much. Brian White will be on again later this morning. And then we've got Nicholas Gibbs on in the evening show. Please hit like and subscribe and notify. And join Patreon. Okay, listen, I need to get out of here. Get this posted. It's been great talking to you.